Have you ever found yourself dreaming about owning a supercar, maybe a luxury watch, or a beautiful vacation home? But then you see the price tag and, well, it feels more like a fantasy. The thing is, this idea we're digging into today, fractional ownership, is making that dream a reality for a whole lot more people. So let's get into it.
I mean, just think about it. What if you could get access to a multi-million-dollar lifestyle without needing a multi-million-dollar bank account? That's the huge promise of fractional ownership. Today, we're going to explore how it works and, maybe more importantly, what you really need to look out for before you even think about signing on that dotted line.
At its heart, fractional ownership is all about a really simple but powerful idea. Why should you own 100% of something you're only going to use, say, 10% of the time? It's a huge shift from owning it all yourself to, smart, shared access. So what is it, really? Well, to put it simply, it's a model where a bunch of people who don't even know each other can pool their money to co-own a really expensive asset, like a luxury vacation home. So instead of one person having to shoulder that entire cost, a small group just splits everything. And right here is one of the biggest differences from other models you might have heard of. You're not just renting time here. You are actually buying a real deeded share of the property itself. And we're talking a pretty significant slice, often something like 1/8 of the whole thing. This means you own actual equity, a real asset that you can sell one day.
The appeal is pretty obvious, right? You get to use these incredible assets for way less money, and all those ongoing costs, maintenance, taxes, all that fun stuff, it's all split. But honestly, the biggest selling point for most people is that a professional company handles all the management. You literally just show up and enjoy it.
Okay, but because this model has gotten so popular, there's a lot of confusion out there. So it is absolutely crucial to understand what fractional ownership is, and maybe even more important, what it isn't.
So this is the big one, the mix-up we see all the time. With a timeshare, you're just buying the right to use a place for, say, a week a year. You don't own anything. With fractional ownership, your name is on the deed. You are a genuine homeowner with a real, tangible asset that could go up in value. That is a huge distinction.
All right, so then how is this any different from just, say, buying a cabin with a few of your friends? The answer is one word: management. If you co-own a place with friends, you guys are on the hook for everything. The leaky faucets, the scheduling nightmares, the whole shebang. Fractional ownership, it outsources all of that stress to a professional manager. You just get to show up and relax.
Now, if you're sitting there thinking this is just about fancy vacation homes, you are in for a big surprise, because the world of fractional ownership has totally exploded.
I mean it. This model has basically unlocked access to a whole universe of assets that used to be the exclusive playground for, the super rich. It's completely changing who can even get in the game in these markets.
So for all the luxury travelers out there, this means you can own a share in a private jet through companies like NetJets, or get a piece of a high-end yacht. And yeah, in the vacation home world, you've probably heard of the big players like Picasso and Ember.
But what if you're just in it for the investment? Well, fractional ownership opens the door to commercial real estate. You can now buy shares in things like office buildings and warehouses through platforms like Strata, or even get a slice of the residential rental market with companies like Arrived Homes.
And this, for me, is where it gets really, really cool. If you're a collector, you can now own a share of a Banksy painting through Masterworks, or a piece of a vintage Ferrari through Rally, or even a super rare Patek Philippe watch. It's even gotten into pop culture, with platforms offering shares in things like collectible sneakers and comic books.
So the dream is pretty clear, right? You get luxury access, you share the costs, and there's no hassle. But now we have to pivot to the most important and, honestly, the most overlooked part of this whole conversation.
Because the answer to this one little question has massive legal and financial consequences. It forces us to look past all those glossy brochures and really read the fine print. This is the marketing promise, right? This quote from a company called Fractionaried just nails the core appeal. It's ownership without the work. It's a completely hands-off experience. And here's the twist. That central benefit, the professional management that you're paying for, that is the exact thing that can trigger a completely different set of rules and regulations.
And that brings us to this legal idea called an investment contract. There was this landmark Supreme Court case, it's called the Howey case, and it established the legal test for what qualifies as a security, like stocks or bonds. And the definition is actually surprisingly simple.
The Howey test basically has 3 parts. First, you invest your money.
Second, you do it with other people in a shared venture. And third, and this is the important one, you expect to make a profit mainly because of the work someone else does, like a manager.
Okay, so now let's connect the dots back to fractional ownership. When a company starts talking about how their expert management is what's going to maintain the asset's value, well, they could be tripping that third wire in the test. Your financial success is now depending on the efforts of others.
Now look, this doesn't mean fractional ownership is a bad thing at all, but it does mean you have to be a really informed buyer. You just need to know what questions to ask.
So, here's your checklist. First off, you got to understand the legal setup. Are you buying a deed, or are you buying a share in a company that just owns the asset? You need to find out who makes the big decisions. Get a full breakdown of all the fees, not just the obvious ones. And this is a big one. You have to understand your exit strategy. How do you sell your share? What are the rules? And finally, don't be afraid to just ask them straight up. Is this being offered as a security?
So the bottom line is this. You have to figure out what you are really getting into. Is this like buying a house and then hiring a property manager to help you out? Or is it more like investing in a fund where the manager's expertise is the thing that's supposed to make you money? That line can be really, really thin.
So that's the final crucial question you have to ask yourself. When you go to buy your slice of the dream, that vacation home, that jet, that piece of art, are you buying a piece of property or are you actually buying a security? Because knowing the answer to that question makes all the difference in the world.